Well, good morning, Bob.
Good morning, Bill.
This is FNC's Morning View, and today we're doing something special. We're reminiscing about you celebrating another birthday. That is awesome. And like a fine wine, you're getting better.
Yeah, much older and wiser. Emphasis on the older.
Just don't want to turn into vinegar, right? We probably got half of that covered. But so anyway, we're going to be talking today about expectations, and you know, expectations change as you go through life.
That's true. What I wanted to talk about a little bit was that Scheller wrote an article this weekend talking about a study that he and Case have recently done where actually they did a survey of buyers back in '88, and then they picked this up again with the same survey, or pretty much the same survey, and have done it for the past 11 years. And
so how have the expectations changed?
How they changed, and also looking at the expectations prior to the crash and then immediately after the crash, and looking at, you know, are buyers just sort of blindly going out and buying stuff, or how are they adjusting their expectations?
So is there a herd mentality, like in the stock market? Everybody, as things go up and you go to a cocktail party and people talk about their great stock, then everybody wants to rush in and buy that stock, and then when people head for the exits, they all head for the exits at one time.
And,
how about housing?
And that's good. And in economics, they call that flocking behavior, like, like the birds. And you know, it's really interesting because they can model that behavior very, very effectively just with three basic rules. They have a rule for separation. You don't get too close to your neighbor, okay? They have a rule for alignment. Basically, you're heading where everybody else is headed. Okay. On the average, you look at the average of where everybody else is headed, you head the same place. And then third, you try to move toward the average of everyone around you. Okay?
So you want separation.
Right.
Separation from what?
Your neighbor. You can't bump into them, right?
Okay. Well, that sounds like the odor rule. I mean, you don't want to be too close to them, right?
Exactly, yeah. But so between the separation, alignment, and cohesion, those three principles, they basically can model flock behavior very well, and it applies to a lot of markets as well. If you took those three same principles and applied it to the housing market, the idea would be that with alignment, basically everybody has similar price expectations for the future. In other words, people are aligning themselves with future price expectations.
So we have a neighborhood cocktail party, and we talk about what housing prices are doing.
Right.
And we all develop a consensus expectation
of where they're going.
Where they're going,
right.
And everybody in the neighborhood behaves according to those expectations.
Right. The other thing is cohesion, where basically if you're going to price your house, you're going to price it somewhere around the average price of all the neighbors' prices.
So
right?
My neighbors must be smart because they think like me.
Exactly. And finally, the separation thing. Your house is really a little bit better than everybody else's.
And
right?
everybody has that feeling.
Exactly. So you price yours just a little bit different than they do.
And what's important in your neighborhood is based on what's in your house.
Exactly. And so with those three principles, you observe the same kind of flocking behavior. And so what they were trying to do is to measure this by doing a query of all of these people. They sent out a questionnaire, and people filled it out, and they've been doing it. And what they found was that back in 2004, people tended to under-expect what was actually going on in the near term, but over-expect what was going to happen long term.
So they couldn't believe how good things were
right.
when things were going really well. And then, but they looked out and they said, this is going to continue forever.
Right. I mean, they use things like, the terms like, you know, that we've got a large number of people moving in, the immigration's high, but there's a limited number of houses, limited
They're not making more real estate.
Exactly. You've heard all those things.
Exactly.
You know?
It is sticky.
And so it's going to go to the moon forever, you know. And
the whole concept of cycles and markets out the window.
Exactly. And so there was no discussion of any of the cycles or bubbles or anything in 2004.
People didn't incorporate that in their expectations.
Right. And their expectations were, in fact, that there was going to be a 12% annual increase in housing prices.
Which is about what it was at the time, maybe a little less than what it was, depending on the market.
Yeah.
And so it was going to continue to go up.
Right. And so for if you were to buy a $100,000 property, put 10% down, basically you were looking at a 6% interest on the loan. You were looking at about a 66% return on your money in 1 year. That's not bad.
That's fantastic.
You know, so that's what people were thinking. And then,
and that was, did that include the tax benefits or just pure cash on cash?
Cash on cash.
So with the tax benefits included with the mortgage interest deduction, it was spectacular.
Yeah, it was great. That's why everybody was jumping in, you know. And no one was talking about a downside. But then between 2004 and 2006, and we hadn't had the big financial crisis yet, between 2004 and 2006, their expectations switched.
Well, but before we leave the expectations in that period of time, what happened was you also had a relaxation of underwriting standards, and so it was much easier to get the money.
Right, the demand was so high, the banks were just basically processing the stuff as fast as they could.
And we got to really relax or really lax underwriting standards in from 2006, 2008 before the
right.
went off the cliff.
And so one of the things that they were trying to do is to say, okay, well, let's look at some of the different scenarios that can occur and what impacts people's expectations. They looked at the blip that we had in 2009, you know, where all of a sudden housing prices started going up,
Right.
and then they turned around and went back down. And they thought, well, let's see what people are saying. No one mentioned any of the government programs like HAMP or HARP or HERA or DUPO, and what was the other one? And anyway, there was a whole bunch of those, and no one ever mentioned any of those. The awareness of those was very limited. What they all did understand was the home buyer tax credit. That was mentioned a lot.
That's in my pocket.
Right. And I think, and the expectation is that they, based upon that, they felt like, well, this is not going to last forever, so I'm going to go out and I'm going to buy now. And that caused that blip. It expired. Prices
So
went back
short-term
down.
incentives do work if it's meaningful to me.
Exactly. But right now, let's look, you know, the expectations that they're talking about are saying, okay, well now what are people thinking today? And the expectations aren't generally very good. They don't see the market coming back very strong right now at all. And so the question is, how fast can those turn? Clearly with the flocking behavior, it can turn really fast.
Well, if we go to the stock market and we look at equities and what happens in the equity markets, we know that historically the consensus tends to be wrong.
Uh-huh.
People think it's going up. Right. In fact, we see these fantastic articles in publications such as the Wall Street Journal, great forecast of increases right before there's a big downturn.
Exactly, yeah. Everybody jumps on the wagon and then...
And so there are low expectations. People don't expect things to go up very much. We may see this as the low point of housing.
Right. And one of the things, exactly, you know, and one of the things that happens is that it doesn't take much to start turning things around, you know, because particularly in today's market where there's so much more information about housing than there used to be, and the internet and social media, so that you can
Rates are low.
rate your low. And
We've got supply constraint, and all we need, people go to work.
right.
They'll start buying.
And employment rates are looking better. The number of, over the past, I believe it's 10 months, 12 months, something like that, there have been about 150,000 new jobs on average. And the sustainability rate for any level of unemployment is 90,000. So we're well over what's needed to just sustain the growth.
We just have a lot to make up.
We do. We have a lot
come way
to make
down.
up. Right.
And as that comes back with new housing starts, you gave us new housing starts last
Right.
week. New
They're
housing
starting
starts
to
are
come
down and constrained because of financing, because of lots of things, but they're constrained. And so as we see demand come back in the marketplace, if we start up because of the leverage factor in
Right.
real estate finance, up we'll go. Now, underwriting is more stringent, and we've talked about some of the constraints on getting these loans through the pipeline in previous discussions,
Right.
but still, prices will tend to drift up.
Yeah, and so, you know, this concept of going viral, you know, that's everybody talks about these days. So something catches people's attention, and all of a sudden, boom, it's everywhere. Housing price expectations, the same type of thing can happen.
Well, since you talked about the birds and flocking, let's talk about flying in formation. And typically, when birds fly long distances, such as geese, there's one that leads. Let's talk about markets that might lead this flocking behavior. Any speculation on that?
Well, the speculation is typically toward the coast,
Sand states?
sand states, because that's where the most volatility is. And when things start happening, it's likely to start happening there. The central part of the country tends to be stable. It doesn't go up much, doesn't go down much. But on the coast, things went way down, and we're starting to see evidence of significant
We've seen
uptick.
stability?
We've seen stability across the country, and now we're starting to see significant upticks along both coasts. So maybe that's a good sign.
That's a great sign, and we're all about the birds today. This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. We hope you all have a fantastic week.